Good morning. Today, in the continuation of the above video in business finance or the finance for business, we are going to see the key concepts in which the risk and returns, how it acts a play important role. The higher risk, the higher return. Yes, as I said, if we take the risk higher in our business, the opportunities of getting returns will be higher. As vice versa, if the risk has been taken in a very low level, the return also will be in very low level. The diversification, yes, of course, the diversification can effectively mitigate overall all risks. How we diversify the allocation of resources in various sectors, which keeps the risk value is very low. If we dump one in one place all the value of business, or if we are investing whole amount in one particular place, definitely there will be the risk is higher and the return will be very less. If we diversify the allocation of resources into different sectors, definitely we will get the returns in a good way, and the risk is also will be a moderate thing. Risk adjustment return, it says about the understanding risk where the adjusted returns is crucial for success, because in every business there is a point called crucial moment where if we understandingly adjust the risk according to the go through of the flow, the risk will be very low. Next, we will say about the stocks and bonds. Stock offer higher returns with a higher volatility than the bond. Yes, of course, if we consider the bond, the returns in the bond is very low, but in the stock we have the highest range of risks. These are the key concept of business finance, risk and return. Next, we will just move on to the foundation concepts and the financial statement. There are so many financial statements we used to learn from our childhood: balance sheet, income statement, cash flow statement, profit and loss account, trial balance, etc., etc. We used to have so many financial statements, but now we are going to see the one among the three. The first one is the balance sheet. Balance sheet, which is consists of assets, liability, equity, and specific points in time. Here in balance sheet, it shows the balance of how the surplus or the deficit made in an account, in the journal entries throughout the year. The income statements says about the what are the incomes we get, that is let us see the revenues, profit, gains, and whatever. And also it shows about the expenses, whether we get some credit from some persons, or we have given some we had made some purchases. All expenses in the organization will come charted on the income statement. Cash flow statement is one of the thing which gives a detailed version of the cash inflow and the outflow for a business, because if we have a cash flow statement of an organization, we can easily say how the cash moves into the organization, and we can easily found whether the organization is in a sound position or it is in a not in a sound way, because it gives a detailed explanation of how the cash comes into the business and how the cash go out of the business, that is outflows in a business. Next, which comes the investment decision, because it is very very important for a person to invest his amount, his savings or whatever it might be, how he invests in a business. There are so much of scope in investing the business. The first and foremost point we just get into is the capital budgeting, which involves a deciding whether the long term period projects into invest in future growth or not. And then the same way we will able to see the working capital management focuses on managing short term assets and liabilities efficiently. Next scope in the investment, we used to see the dividend policy, which determines how much profit to distribute to the shareholder and the reinvesting. For example, evaluating a new factory net present value within a 10-year project. This is the scope where a person can take a decision on his investment. Thank you.